Well, I think one of the common misconceptions out there in the marketplace is that high-yield bonds are actually risky. In fact, the common name is called junk bond to describe the market. But if you look at a lot of these companies, they're very well-respected, well-regarded companies that just tend to operate with a higher degree of leverage. And so many of these companies, in fact, 17% of the S&P 500 index has bonds that are rated below investment grade. So a lot of companies in the United States just choose to operate with a higher degree of debt on their balance sheet. And it works for some industries that have high cash flow, and other industries where there's not much cash flow and it's more of a growth story, it's less appropriate for. No, it's not. Well, it can be. For example, if a company is deteriorating fundamentals and it has to borrow more and more debt to fund its operations. But a lot of these companies tend to just have higher degrees of leverage throughout their life cycle as a company, just because they're more of a cash-generating company as opposed to a growth company. The one area that would be true are what we call fallen angels, or companies that were once investment-grade companies that had slowly deteriorated into high-yield companies. For example, a lot of newspapers right now fit that description, where they've had to increase debt and the fundamentals have eroded such that their debt levels have increased relative to their cash flow. But for the most part, it's not necessarily a symptom of a bad company. Quantitative easing is an unproven economic policy. We're not quite sure how it's going to work out. The stated goal is clearly to provide some inflation in the economy and also to, I think, boost confidence, more importantly. To the extent that this can boost confidence and reignite the animal spirits in the marketplace to increase more risk, I think that's what the Fed's striving to do. So what they're doing is reducing the amount of compensation that you get on safer securities, such as treasury bonds, etc., and almost forcing you to invest in higher yielding securities and to take more risk. And so they're trying to encourage that behavior. Now, we all know from our banking classes that if you just flood the economy with money, it's not going to increase economic growth per se, or real growth. But what they're trying to do is increase the nominal growth and try to grow out of this indebtedness that we're in. Whether or not it's successful remains to be seen. We think they'll be modestly successful. And I think the bigger question is, how long can this go on, and when does the handoff occur where the private sector actually picks up the baton, so to speak, and starts investing in the economy and buying more goods and services, etc. But overall, I think one last quick comment is that there will be some unintended consequences from quantitative easing. One of them may be higher commodity prices, and that liquidity might funnel its way into some area of the marketplace that we're not really thinking about right now. You're already starting to see it with commodity prices a little bit. But for the most part, I think it's very advantageous and very positive for capital markets in the short term. As you can see, the main beneficiaries of this quantitative easing have been the riskier assets in the marketplace, such as equities. Well, I think what's happening in the economy is that the consumer is spending less, and so to fill the gap, the government is spending a lot more, and they're trying to compensate for the lack of consumer spending. The U.S. consumer has overconsumed the last 10 to 15 years, and likely going forward, they'll be a lot more modest in their spending. Now, as it relates to high-yield companies in the corporate sector, what you've seen is a lot of deleveraging, and companies are actually improving their leverage metrics. And one of the metrics that we look at is debt divided by cash flow, or EBITDA, and that's declined from around 4.5 times to around 4 times. So that multiple has been declining, and I think we'll continue to see that over the next year or so, where the multiple of debt that you have on cash flow slowly declines. Everyone has their own thought process on this, but typically high-yield companies are ones where they can support higher debt levels via a lot of a strong amount of free cash flow is what we call it. And companies that provide a lot of cash flow are businesses that usually have a lot of operating leverage and can, via some small increases in sales, produce positive cash flow that's sufficient enough for the company not only to operate, but also service their debt and their obligations, etc. Companies that would not be a good fit for a high-yield balance sheet would be technology companies or a growth company where you're trying to grow sales going forward and you may not be cash flow positive. You may not have enough money to pay that higher level of interest payment. And so I think typically what you look for are companies with high degrees of cash flow on a monthly basis. And not only that, but companies that have very reliable, very steady and dependable cash flow throughout their life cycle. I think right now the area that we think is the most attractive is the utility industry within the United States. There are two sections of the utility industry. There's the regulated side, which basically serves the customers that buy energy prices or that pay their electric bill. And then there's those the area of the market where we call the power producers, the ones that actually generate the energy. And for the most part in the United States, it's coal, nuclear, and gas. Coal is 50%, and then the other two are nuclear and gas. The gas-fired generation facilities in particular are very attractive right now. You can buy bonds at a third to a quarter of replacement value. And even though power prices are depressed right now, we feel as though that with slow economic growth going forward, even if it is slow, the power prices are likely to improve, and you'll see a lot better multiples being paid for these companies in the future. In addition to that, it trades very cheaply compared to the rest of the high-yield market, and it's an area that we feel as though will be very attractive going forward on a risk-return basis. Which sector is most at risk? Well, the default rate, as you mentioned, has fallen from 15% or almost 15% to, I think, 3.8% as of last month. So it's declined drastically. And usually you see a corresponding spread amount. For example, 4%, you see 400 basis points in spread premium. And 6%, you see 600 basis point premium in the market. Right now, I'd say the area that has the highest probability of seeing defaults, there are two areas. The first one is the gaming or casino area of the United States. The U.S. Probably overbuilt in Las Vegas, and Las Vegas became more of a destination, a family destination, as opposed to a traditional route of more of a gambling environment. Because there's a lot of excess capacity in that industry, you're likely going to see a few, at least maybe not defaults, but certainly restructurings in that area of the high-yield universe, because the debt loads there are unsustainable for some of the larger entities in that area. The other space that I think will see some defaults are probably the legacy LBOs that we saw in 2006 and 2007. They financed those opportunities with a very large amount of leveraged loans, or what we call bank debt. Those bank debt securities come due in 2013 and 2014. And I think that's really the next wave of defaults, or the next challenge we have as a high-yield market to get through and to see if they can manage those liabilities. But in the short term, over the next year or two, you're not likely to see a huge pickup in defaults, because so much of the financing in the high-yield market recently has been to push out maturities beyond 2015. And that longer runway, or that amount of breathing room, so to speak, is going to give companies the ability to improve their operations and manage through the cycle. Which ones offer the most security? Well, I hate to go back to utilities. That's one of our big holdings, but we think it's very interesting because your downside is somewhat limited, because you're investing at a third to a quarter of the replacement value or the construction cost of those industries, and the yields are very high right now. I think other areas that we like a lot are floating rate loans, because you're secured, and also you have a floating rate instrument, so to the extent that interest rates do rise, you should see some benefit to that, as your prices will actually improve as interest rates move higher. So I think those are two areas. One other additional area that may not be as attractive as it once was, but it's the secured aircraft industry within the United States. It's called a EETC, or Enhanced Equipment Trust Certificate. It's a not widely followed area of the high-yield market, but with these securities, you have a secured claim on aircraft. They typically have more than 1 times asset coverage, and they're very safe, very solid, and as opposed to unsecured or equity investments within airline companies, you have a secured claim on an asset, and they actually do quite well even in a bankruptcy scenario. Well, I think our outlook is that you're likely to see a very low growth environment going forward. And on one end of the spectrum, you have government bonds, which are artificially low due to the Federal Reserve. On the other end, you have equities, which rely a lot more on earnings growth. And so we view high yield as a happy medium where you can get paid to wait, so to speak, via current income with that cash component that you get via returns in high yield, roughly 7.5% right now. So from our perspective going forward, you're likely going to see high single-digit returns over the next 2 to 3 years until we get perhaps to the next credit cycle, and it's very attractive from that perspective. And equities, we would argue, are still going to do okay, but we feel as though it might be more competitive with high yield in the high single digits area, not the 15 to 20% that investors are used to seeing over time. Our belief is that high yield is a very attractive asset class, not only as an equity alternative because you have similar returns with less volatility, but also as a complement to Treasury, government bonds, et cetera. And I think for the risk-tolerant investor, a 5% allocation is a very modest allocation is probably okay for most investors. Those that are risky or have riskier appetites can certainly increase that. But even for the most conservative investors, I believe a very small weighting towards high yield is very appropriate and a very good complement to other opportunities out there.